retail. Well, my next guest, she says she's got more warnings for you. Joining me now, Main Street Asset Management, LLC, Chief Financial Officer, Aaron Gibbs. And Aaron, so what are you cautioning investors about now? What can we add to the list here?
So I think quality, not quantity, but to add it, I think it's be nimble, be willing to change, don't get stuck in a rut. I can't think of an Aesop fable that would quite match that.
But you are concerned, though, right?
Yep.
And do you think people are just too antsy, trying to get back in too soon, or?
So we've seen this risk on trade since mid-October, and obviously, you know, the yields really started dropping. It seems to be waning a bit, and I think we may see a little more a sort of bounce between risk on, risk off days until we get the December Fed meeting, because I think that's really sort of at the forefront of everybody's minds for, like, let's say the next 3 weeks.
I had Lance on earlier. We were talking about the forward PE ratio, now back up to 17.5. That's too high for a lot of people. I think you included.
Yep.
You know, we got down here the last time the market was in trouble. I'm sorry, this is not last time we were in trouble, but we got down to maybe a lot lower, right?
Yeah.
I mean, where do you want to see the forward PE ratio?
So if we look in an area where we're sort of in a more slower growth, you know, more mid-level type of interest rate environment, we're looking at more of a 16, and that's sort of back back in the 90s, back in sort of the economic recovery.
That's not too far from here.
And that's not too far, but it is still, we're talking from 18 to 16, we're still talking, you know, 10 to 15% potential, and I think that's what we could be worrying about if the Fed looks a little more hawkish, if we see some inflation numbers that aren't going in the right trend. That's what you could see on your downside potential.
It doesn't have to hit that, though.
It doesn't have to.
Okay. Let's talk about an old saying, the stock market is not the economy is not the stock market. And here's a perfect example. The S&P 500, 62% of the earnings come from goods, but in society at large, our economy, only 32% do, and 59% come from services. And the reason I bring that up is, you know, I think a lot of these service stocks get lost out there, like they don't get a lot of props or whatever. You know, we've been focused on goods for a long time.
Yep.
You like this company, this bookings.com.
Yeah, and one of the reasons, one, it's consumer discretionary. So we really look, when you're looking at actual earnings and back to fundamentals rather than macros, the consumer discretionary sector and a lot of its subsectors are the one area where we're looking at really massive profit growth versus a lot of other industries where we're seeing really big contractions or big downward revisions.
And you've been studying the earnings revisions here, which, unlike the broad market, are going in the other direction.
Exactly. So the broad market revisions are just going down, down, down. They've almost been cut by 1/3. And when we're talking about profit growth for next year. Booking is actually increasing, and a lot of these hotels, restaurants, these types of entertainment services are actually increasing for next year. People think they're actually going to do better than they did a month ago, which is unusual because generally right now the outlook is sort of a little pessimistic.
It is a little pessimistic, although I put YOLO, you only live once, because I had a friend, two friends, they went out to Vegas, and once she just never leaves the house. I was shocked. They called my wife, yeah, we're in Vegas. So it's not just the young kids, everybody's on YOLO, and maybe that will help booking as well.
Yep.
Aaron, thank you very much.